Imagine two ships on opposite ends of the hemisphere. In the south, a rust-streaked oil tanker glides out of a Caribbean port, loaded with heavy crude from Venezuela's vast reserves. The sun is brutal, the water warm, the route familiar. Across the Caribbean, into the Gulf of Mexico, toward U.S. refineries that have been hungry for this exact kind of oil for decades. In the far north, an ice-class cargo ship pushes slowly through gray Arctic seas. The water here used to be locked by thick ice for most of the year. Now, patches of open water appear for longer and longer stretches. Satellite maps show new blue lanes cutting across the top of the world, skirting the coasts of Canada and Greenland. Two ships, two coasts, one unspoken question. Where will the next century of North American power really come from? From the old wells of South America? From the oil sands and gas fields of Canada? From the frozen minerals and shipping lanes of Greenland and the Arctic? Or from a mix of all three, stitched together into a new resource triangle that quietly reshapes America's energy security, Canada's export future, and Greenland's once silent coastline? Today, we're going to follow those ships. We're going to look at how a sudden reset in Venezuelan oil, a stable but vulnerable Canada, and a thawing Arctic around Greenland are creating a new map for energy, shipping, and wealth in the Western Hemisphere. This is not a video about who is right or wrong in any conflict. It's about how geography and geology are being rearranged into a trillion-dollar triangle, and what that might mean for ordinary people and the global economy. Welcome to the new resource triangle. Act 1, the old energy order. To understand what's changing, you first have to see the world that's cracking. For most of the last half-century, the story of oil and power had three main pillars. The Middle East, with its giant conventional fields and OPEC clout. The United States, first as a huge importer, then as a shale-driven producer. A ring of nearby suppliers that fed U.S. refineries. Canada are oil sands to the north, and Venezuela's heavy crude to the south. Canada and Venezuela were like two ends of a barbell. Both hold enormous reserves of heavy oil, thick, dense crude that requires complex refining but can be very profitable in the right conditions. Both are relatively close to the huge, sophisticated refinery complexes along the U.S. Gulf Coast, which were built and tuned over decades to handle that exact type of feedstock. For years, Venezuelan barrels and Canadian barrels competed and combined in those refineries. Then the story broke. Venezuela, the sleeping giant that fell asleep on its own arm. On paper, Venezuela is an energy superpower. It sits on some of the largest proved oil reserves in the world, much of it in the Orinoco Belt. Huge volumes of heavy, extra heavy crude, but a mix of underinvestment, corruption, mismanagement. And later, international sanctions tied to the country's political and economic crisis crippled its production. By the late 2010s and early 2020s, Venezuelan output had collapsed from pre-crisis highs of around 3 million barrels per day to a fraction of that. Sanctions by the United States and other countries restricted its ability to export oil, access financing, and import the technology and expertise needed to maintain its fields. Venezuela, the energy giant, became a kind of sleeping dragon, dangerous in theory, but half paralyzed in reality. Canada, the quiet pillar. While Venezuela stumbled, Canada filled part of the gap. The oil sands in Alberta, along with other conventional fields in Western Canada, provided a steady stream of heavy crude to U.S. refineries via pipelines and rail. Canada's advantages were simple: political and economic stability, proximity to the U.S. market, long-term relationships with refiners. Its disadvantages were equally clear: higher production costs, especially for oil sands, environmental concerns and regulatory complexity, limited ability to pivot quickly when prices crash or surge. Still, compared to the volatility of Venezuela, Canada looked like a rock. U.S. energy planners quietly liked having a stable neighbor. Canada AS Oil, along with U.S. shale, helped reduce dependence on Middle Eastern imports and supplied Gulf Coast refineries that had lost Venezuelan feedstock. Greenland, barely on the radar, until the ice started to move, and then there's Greenland. For most of modern history, it was a white patch at the top of the map. Ice, rock, a few small communities, and not much else. But below that ice and rock lie potential oil and gas deposits offshore, significant mineral resources including rare earth elements and other strategic metals, a coastline that sits right next to some of the world's most important emerging Arctic shipping lanes. As climate change warms the Arctic, sea ice retreats and thins. Shipping companies, energy firms, and governments have begun to look at Greenland and the broader Arctic not as a blank space, but as a new frontier of shorter shipping routes between Asia, Europe, and North America, untapped resources, strategic positioning for future trade and security. U.S. interest in Greenland's strategic value, both for its mineral potential and for its position on emerging Arctic routes, has grown noticeably in recent years. The old energy order didn't fully account for Greenland, but the new one cannot ignore it. Act 2, Venezuela. Wakes up economically. Now, fast forward to the present. A series of dramatic political and military events in Venezuela has changed its trajectory again. In early 2026, the U.S. government signaled it intended to take control over, or strongly direct, Venezuela's oil sector after the capture of President Nicolas Maduro, raising expectations of a major reset in Venezuelan production and exports. This is a deeply controversial development politically and legally. But economically, one thing is clear. The world's biggest underused oil reserves might be about to re-enter the game. What a Venezuelan oil reset could mean. If sanctions are eased or restructured, foreign capital and technical expertise can return, and the new arrangement allows rapid ramp-up of production, then, over the next decade, Venezuela could restore a large portion of its lost output, export significantly more heavy crude to global markets, re-establish itself as a major supplier to U.S. Gulf Coast refineries, which are designed for heavy grades. Analysts warn that a Venezuelan oil reset could be both an opportunity and a risk. Opportunity. More supply can stabilize or lower global oil prices, helping import-dependent countries and possibly easing pressure on inflation. Risk. It might undercut other heavy oil exporters, especially Canada, if Venezuelan barrels are cheaper or more politically attractive in the short term. Canada, same barrels, new competition. Heavy oil is not just oil, it's a specific product. Refineries that are configured to process heavy crude rely on a mix of supply sources: Canadian, Venezuelan, Mexican, others. When Venezuelan supply shrank under sanctions and mismanagement, Canadian barrels filled part of that niche. If Venezuelan exports ramp up again, especially towards the U.S., Canadian producers may face tighter price differentials, squeezing their margins. Future investment in high-cost projects, like new oil sands expansions, could look less attractive. Governments that depend heavily on oil royalties could find their budgets more volatile. The Globe and Mail recently described this scenario as an economic risk Canada cannot ignore, highlighting that a flood of Venezuelan heavy crude could challenge Canada's position in global markets. Canada remains politically stable and relatively predictable, but in commodity markets, barrels don't carry passports. They carry price tags. The wider market, more barrels. Same planet. There's another layer to this. The more large producers come back online or expand, the more tension arises between short-term goals, securing supply, lowering energy prices, supporting jobs. Long-term goals, reducing emissions, transitioning to cleaner energy, and meeting climate targets. A Venezuelan reset doesn't happen in a vacuum. It happens in a world where countries have pledged varying degrees of decarbonization, even as they still rely heavily on oil and gas for transport, industry, and heating. In simple terms, the supply side of oil may be about to get more crowded again. The demand side is supposed to decline in future scenarios, but in practice, it has remained stubbornly high. That mismatch is the kindling for price swings, investment booms and busts, and political arguments. Economically, though, the question for North America is, if Venezuelan oil comes roaring back, where does that leave Canada? And what role does Greenland and the Arctic play in this reshuffled deck? Act 3, Canada. Between two frontiers. Canada now finds itself in an interesting and slightly uncomfortable position. On one side, a potential surge of Venezuelan heavy crude that might undercut some of its market share or bargaining power. On the other, a rapidly changing Arctic, where new shipping lanes and resource opportunities are emerging along Canada's northern coastlines and near Greenland. Canada is both a traditional energy exporter, tied heavily to pipelines and refineries to its south, and an Arctic country with vast, sparsely populated northern territories that are on the front line of climate and shipping changes. The southern link, pipelines and refineries. For decades, the core of Canada's energy export model has been simple. Extract oil and gas in Western Canada, move it through pipelines and rail to the United States. Refineries, especially on the Gulf Coast, turn it. This model has been financially rewarding, but it has drawbacks. It ties Canada's fortunes closely to U.S. energy policy and refinery preferences. It concentrates risk. If U.S. demand or policy shifts, Canada may have limited alternative markets ready to absorb its exports. It has sparked domestic debates over pipeline routes, environmental risks, and indigenous rights, though those are political and legal questions, not economic ones. Now add a potential return of Venezuelan barrels into that mix. Suddenly, same refinery slots intensifies. Canada has to ask itself tough economic questions. How much more capital should be invested in high-cost, long-payback oil projects in a world of uncertain prices and increased competition? How can it diversify its energy and export portfolio? What role should its Arctic geography play in that diversification? The northern link, ice, shipping, and opportunity. Look north, and the picture is very different. The Arctic, including Canadian and Greenlandic waters, is warming faster than the global average. That's a climate alarm. It's also, from a cold economic standpoint, a logistics revolution. Thinner and more seasonal sea ice allows longer navigation windows for the Northwest Passage through Canadian Arctic waters, the Northern Sea Route along Russia's coast, trans-Arctic routes that cut across the central Arctic. For shipping companies and trading nations, this promises potentially shorter routes between Asia, Europe, and North America, reduced fuel costs, new hub opportunities in places like Iceland and Greenland. For Canada, more traffic along their coastlines, more interest in building ports, search and rescue infrastructure, and logistics bases, more attention to their subsurface resources, oil, gas, and critical minerals. The U.S. interest in Greenland over the past few years has been framed not just in security terms, but also in terms of shipping and reserves, hydrocarbons, rare earths, and a shipping and reserves case for why Greenland, for its part, has been slower to build deep-water Arctic ports and facilities, but the pressure is mounting as the Arctic becomes busier. Two doors, oil and shipping. This leaves Canada with two metaphorical doors. Door one, double down on being the stable, rules-based oil supplier to a world where Venezuelan and Middle Eastern barrels are politically complicated. Door two, invest more in its northern coast, ports, and logistics to capture some of the value from new shipping routes and potentially future Arctic resources. Realistically, it may try both. But capital, time, and political attention are finite. As the resource triangle takes shape, Venezuela to the south, Canada in the middle, Greenland and the Arctic to the north, Canada's decisions will determine whether it remains mostly the pipeline to America or becomes a more complex player in the next chapter of global trade. Act 4, Greenland and the Arctic, the frozen corner of the triangle. Now let's sail north to the most surprising corner of this triangle, Greenland, from blank space to hot property. For much of modern history, Greenland appeared in school atlases as a gigantic white blob, distorted by map projections, sparsely populated, and seemingly disconnected from the main action. But climate trends and resource surveys have changed that perception. Today, Greenland is seen as a potential hub for Arctic shipping, sitting on the route between North America and Europe as northern passage territory with significant mineral resources, including rare earth elements that are crucial for batteries, electronics, and green technologies. A potential, though still uncertain, province for offshore oil and gas, though environmental and economic challenges remain. U.S. think tank and media analysis now regularly discusses U.S. interest in Greenland in terms of both shipping lanes and resource security. The Arctic shipping revolution. To understand the economic pull, picture a container ship sailing from East Asia to Europe. Traditionally, it has two main options. Go south, through the Strait of Malacca, across the Indian Ocean, through the Suez Canal, into the Mediterranean, then up to Europe. Go east and south around the Cape of Good Hope if canals are blocked or risky. Both are long, crowded, and vulnerable to choke points. An Arctic route, in contrast, cuts distance and therefore time and fuel costs. Bypasses some traditional choke points, offers new strategic choke points in the north instead. For example, analysis of the scramble for the Arctic has highlighted how melting sea ice is opening routes that attract shipping companies and major powers looking for shorter Asia-Europe links. Greenland sits along this emerging web of northern routes. That means ports in or near Greenland could become key refueling, repair, or transshipment hubs. Its proximity to potential trans-Arctic lanes puts it in the center of new maritime patterns. Minerals and energy in the north beyond shipping. Greenland is rich in rare earth metals used in electric vehicles, wind turbines, and electronics. Other strategic minerals. Potential offshore hydrocarbon deposits, though exploration is difficult and controversial. For countries like the U.S. and its allies, having access to non-Chinese sources of rare earths and critical minerals is a strategic economic goal. That's why Greenland, despite its small population, appears in debates about secure supply chains, diversifying away from single suppliers, building a more resilient green tech economy. The challenge, opportunity versus preservation. Economically, Greenland and the Arctic coastlines of Canada and other nations represent new shipping routes that could save time and money, new resource plays that could feed the world's appetite for energy and materials, but they also come with harsh conditions that make accidents more dangerous, sensitive ecosystems that recover slowly, infrastructure deficits, few ports, limited search and rescue capacity, weak communications in some areas. So the economic question is not just how much can be extracted or shipped. It's how safely, how sustainably, and at what pace. For now, the Arctic is less about immediate oil booms and more about long-term positioning. Who builds the ports? Who invests in ice-capable fleets? Who controls key straits and passages? Who secures the mineral deposits that will power the global energy transition? In that contest, Greenland is no longer a blank space. It's one point of a triangle that stretches down through Canada and into Venezuela. Act 5, the triangle's future: power, risk, and everyday life. Bring these three corners together and you get a picture of the next few decades that is as fascinating as it is uncertain. Venezuela, Canada, Greenland, South, Center, North. Three very different places tied together by oil and gas, minerals and shipping lanes. The strategic needs of the largest economy in the hemisphere, the United States. For the U.S., from customer to coordinator. The U.S. used to be primarily an oil importer, heavily reliant on Middle Eastern suppliers. The shale revolution reduced that dependence, but did not erase the need for steady, diversified supplies. Now, with Venezuelan reserves potentially back in play, Canadian heavy crude still crucial to refinery operations, Greenland and the Arctic rising as strategic frontiers. The U.S. is positioned less as a simple customer and more as a coordinator of a hemispheric and Arctic energy space. Economically, that could mean more bargaining power over prices and contracts in its immediate neighborhood, more options to reroute supply in case of disruptions elsewhere, more leverage in setting rules for Arctic shipping and resource development, but that power comes with legal and diplomatic complexity, the risk of overextending into volatile regions, the temptation to treat energy and mineral wealth as an ATM instead of a foundation for long-term investment. For Canada, pressure from both directions. Canada faces a double challenge. In the south, it may see increased competition from Venezuela and others for refinery space in global heavy oil markets. In the north, it must quickly decide how much to invest in Arctic ports, shipping, and resource exploration while balancing environmental and community concerns. If it moves too slowly, it risks losing market share in oil without building new strengths elsewhere, watching Arctic routes develop around it instead of through it. If it moves too fast without careful planning, it risks stranded assets in a world that does eventually move away from fossil fuels, underestimating environmental and social costs in sensitive northern regions. For Greenland, from remote to central, Greenland, with its small population and limited infrastructure, suddenly finds itself in a position many small territories never face, sitting on top of resources the world wants, sitting next to sea lanes that big powers care deeply about. Economically, that brings potential investments in mining, shipping, and infrastructure, higher revenues and jobs, and also the risk of dependency on a narrow set of industries. The classic resource curse trap if windfalls are not managed well. For ordinary people, what actually changes? For most viewers, the key questions are simple. Will this make energy cheaper or more expensive? Will it create stable jobs or just another boom and bust cycle? Will it accelerate or delay the shift to cleaner energy? In the short term, a Venezuelan oil reset and increased hemispheric supply could help moderate or reduce global oil prices, which can ease pressure on fuel. Competition between suppliers may push some to improve efficiency. In the long term, if governments treat new revenues as a windfall to spend immediately, then little will change structurally. If they treat them as an opportunity to invest in diversification, education, technology, and infrastructure, then the triangle could help finance a smoother transition to a lower carbon economy. In other words, the resource triangle can be a bridge to the future, or another detour. Final thoughts are rocks, ice, and choices. Let's go back to our two ships. The tanker leaving Venezuela, heavy with crude that sat underground for millions of years, now re-entering world markets under a very different geopolitical arrangement. The cargo ship crossing the Arctic, gliding through water that used to be locked in ice, tracing a new route that could reshape global trade flows. Between them lies Canada, with pipelines to the south and coastlines to the north. Add Greenland to that picture and you no longer have isolated stories. You have a triangle of old carbon wealth and new shipping paths. A triangle of economic opportunity and climate risk. A triangle that could either lock the hemisphere into another century of resource dependence or help fund a careful transition out of it. None of that is inevitable. It depends on choices. How quickly Venezuela's oil sector is rebuilt, and under what terms. How Canada balances short-term energy exports with long-term diversification. How Greenland and Arctic states manage shipping and resource development in some of the most fragile waters on Earth. So if you remember one thing from this video, let it be this. Maps change slowly. But when they do, the consequences last for generations. Right now, the map of energy, shipping, and wealth in the Americas is being redrawn from the Orinoco Belt, through the oil sands, up to the Arctic ice edge. The triangle is forming. What we do with it is still up for grabs. If this helped you see the bigger picture behind the headlines, share it with someone who thinks Venezuela, Canada, and Greenland are separate stories. They aren't. They're three corners of the same future,